Friends, welcome to this rapid audio revision series on accounting standards of Group 2 Advanced Accounts. I am CA Jayesh Popat from Jayesh Popat's Classes, Kolkata. Please download the revision notes from the link given in the description. Also, subscribe to our YouTube channel and hit the bell button to stay connected. You can join our Telegraph channel and download our mobile app from the links given in the description. I hope these revision notes will help you to easily, effectively revise your accounting standards in the shortest possible span of time. All the best for your exams. Thank you. AS5, net profit or loss for the period, prior period items and changes in accounting policy. Basically, the objective of this standard is to prescribe classification and disclosure requirements for certain incomes and expenses in the statement of profit and loss. The objectivity is to bring uniformity and enhance the comparability of the financial statement. So this standard will give us guidance in dealing with income and expenses in relation to these 5 items: profit or loss from ordinary activities, extraordinary items, prior period items, changes in accounting estimates, and then it will deal with disclosures of changes in accounting policies. This standard although gives us guidance in relation to these items, but this standard does not prescribe the tax implications of extraordinary items, prior period items, changes in estimates and changes in accounting policy. This standard says that the net profit or loss for the period should include all the expenses and incomes which are recognized in the current period, unless there is an accounting standard which suggests a separate treatment. For example, AS16 says that borrowing cost means interest relating to certain items should be considered in the cost of those items of PPE or stock. First, let us talk about profit or loss components. It says that the net profit or loss would comprise of 2 items: profit or loss from ordinary activities and extraordinary items. First, we'll talk about ordinary activities. What do we mean by ordinary activities? Ordinary activities are those regular activities which are conducted as part of the business and such related activities which the enterprise performs in furtherance to or in incidental to their main activities. How do we deal with these ordinary items? These ordinary items should be recognized as an income and expense in the profit and loss as part of ordinary activities. But if these items are of such size, nature or incidence that their separate disclosure would be relevant, then in that case the nature of those items and the amounts involved should be separately disclosed. For example, normally we do domestic sales, but in a particular year we received a huge export order, right, and our sales significantly increased. So although sale of goods is an ordinary item, but there is an exceptional item included, right? We call this as an exceptional item because of the size, nature and incidence. We may want to disclose this separately in the financial statement so that user of the financial statement can get to know that why the amount of sales has significantly gone up. Example of such items means these are ordinary items. These are related to the ordinary activities of the business, but still because of their size, nature and incidence, they may require a separate disclosure. Some examples could be bringing down the inventory to its net realizable value and reversal of that, restructuring activities, disposals of fixed assets, disposals of long-term investments, then litigations, right? These type of items may be such for which separate disclosure may be required. Now let us talk about extraordinary items. See, these extraordinary items are also items of income and expenses, but these arises from events or transactions that are clearly distinct from the ordinary activities of the enterprise, and therefore their occurrence may not be frequent or regular. How do we deal with these extraordinary items? The nature and the amount of these extraordinary items should be separately disclosed so that the user of the financial statement can get the impact of these extraordinary income and expenses in the profit and loss account. What do we mean by clearly distinct? Because the differentiating line is that they should be clearly distinct from the ordinary activities. Clearly distinct would mean based on the nature of the item. The nature of the item is such that these type of transactions or these type of event, right, are not part of the ordinary activities of the organization. The recurrence or frequency may not be the deciding factor, but the nature of the item will be the deciding factor. Example, let's say attachment of property of the enterprise. Government has passed order for attachment of the property. Maybe there's an earthquake and there's a significant loss which the enterprise is facing. These items do not occur generally in the ordinary activities of the the business. Now we'll talk about the prior period items. These are also items of income and expenses which are recorded in the current period as a result of errors or omissions in some previous period. So if we had not made an error or omission in the prior period, such items of income and expenses would not have arisen in the current period. Since there were mistakes, errors, omissions in the prior period, that is why this income or this expenses has been recorded in the current period. How do we deal with this? We should disclose separately the nature and the amount of such prior period items so that the users of the financial statement are clearly able to understand that what is the impact of the prior period item in the current year's profit and loss. They should be able to see a picture that what is the actual profit for the current year and what is the impact of the prior period items in the current year's profit or loss. So basically their disclosures can be made in two ways. Either they may be included in the net profit or loss for the period, or maybe it could be shown as a separate line item. Maybe you will say net profit for the period, then add or less prior period item, and then final amount of profit arises. The ultimate objective is that the user of the financial statement should be able to perceive the impact of these prior period income and expenses on the current year's financial statement. Now a very important thing which you all need to understand is that we will call an item of income and expense a prior period item only when it arises in the current period as a result of an error or omission in the prior period. But there could be a situation where certain items relating to prior period may come in the current period, but that is not because of error and omission. Let's take an example. Maybe we are in a wage negotiation with our workers, right? We have offered them a salary of, let's say, 10,000 per month, but the negotiation is still on. So we have booked our liability as 10,000 per month. Finally, when the, let's say, negotiation was concluded, right, we ended up giving them a salary of 12,000 per month. And this additional 2,000 we have to pay retrospectively from, let's say, last 2 years. So this retrospective revision of last 2 years into 2,000, right, we will record certain amount in the current year. This 2,000 which is relating to the prior period but which is arisen in the current period will not be considered as a prior period item. Why? Because in the prior period item we did not make a mistake. We were offering 10,000. When the negotiation was completed it was 12,000. So this is based on new information or new circumstances which arose. It will not be considered as a prior period item. Only when it arises because of error or omission in the prior period item, it will be considered as a prior period item. If the amount has been determined in the current year relating to certain prior periods, then it will not be considered as a prior period item. Then we will talk about changes in accounting estimates. See, by estimates we mean that we are making the amount is not certain. There are several items in our financial statement for which we need to make an estimate. For example, let's say depreciation. Depreciation is an estimate based on the, let's say, the useful life of the asset. Then maybe there are certain claims, there are certain, let's say, litigations which are on, there are certain demands which are raised by the income tax department on the company, right, where there is, let's say, a court case which is going on and we don't know with certainty what is the amount involved. So based on our best estimate we record an amount in the books of accounts. So once the circumstances based on which these estimates are made changes, the amount involved will also change. So basically, how is an estimate made? Estimate is basically made based on the past experience and it is also made on the basis of latest available information. So in relation to these estimates, we need to continuously review these estimates as each financial year end, and if there is a change in the circumstances in which these estimates are made, or maybe there are new, let's say, information which has come in, or there is a subsequent development, the amount of the estimate may change. So how do we deal with a scenario where there is a change in the amount of estimate, right? It is to be included in the determination of net profit or loss. When the change of the new information arises, you have to record it in the same period. and you have to use the same classification under which you had recorded that income or expenses in the prior year. For example, let's say initially we were depreciating an item of PP taking 10 years as its useful life. Subsequently, maybe after 3 years we realized that the useful life is only 5 years. So now the depreciation charge will increase. This additional depreciation which is arisen in the current period because of change in the estimate, right, will also be recorded under, let's say, the depreciation expense. Another example, let's say there was an income tax notice which was served on our company, right? The demand amount was 5 crore rupees, but based on evaluation and merit of the case, we recorded a liability of 2 crore rupees, right? Afterwards, maybe after a couple of years when the proceedings are on, we get to know that no, now the liability could be, let's say, 3 crore rupees. So we'll provide 1 crore additional. There's a change in the estimate, and this 1 crore will be provided under the same header in which we have recorded this 2 crore earlier when this particular provision was made. Then, how to make a disclosure in relation to this? We need to disclose the nature and the amount of the change in accounting estimate if the amount is material and has a material effect either in the current year, or it is expected that it will have a material effect in the future period. If it is not possible to determine the amount, then we will state the fact that we are not able to quantify the amount. In order to ensure comparability of the financial statement, right, if earlier period we had recognized that particular item as ordinary activity, when there is a change in estimate, that changed amount, right, the differential amount will also be recorded as under ordinary activity. If in the previous period this particular item was treated as an extraordinary item, when there is a change in the estimate and we need to provide additional amount, this additional amount will also be considered as an extraordinary item to maintain comparability of the financial statement. There could be a circumstance where you are not able to distinguish or differentiate between a change in accounting policy and a change in accounting estimate. So when you are not able to distinguish between change in accounting policy and change in accounting estimate, you need to treat this change as a change in accounting estimate and you have to make appropriate disclosures. Now we'll talk about accounting policy. AS1 we have already done. We know that accounting policies are certain set of rules or principles based on which you do accounting in your books of accounts. So accounting policies are specific accounting principles and the methods adopted by the enterprise in applying those principles in the preparation and presentation of the financial statement. Can you change your accounting policy? The principle of consistency, the fundamental accounting assumption of consistency requires that an enterprise should not change its accounting policy. Accounting policy should be consistent from one period to another. But AS5 gives an option to change accounting policy. There are 3 circumstances under which you can change your accounting policy. If it is required by statute, means if it is required by the law for compliance with an accounting standard. So there is a change in accounting standard, or maybe there is a new requirement which has arisen, so you need to comply with it. And the third option is given to the management. It says that if the change will result in more appropriate presentation of the financial statement, then also you can change your accounting policy. But please remember that if there is a new transaction which has come in place, and for that new transaction you are adopting an accounting policy, that will not be treated as a change in accounting policy because you did not have an accounting policy for that. If there is a new circumstances of the transaction is substantially different from the earlier transaction, and for that you need to adopt a new accounting policy, that will not be treated as change in accounting policy. So what do you need to do? Any change in accounting policy which has a material effect should be disclosed. What should you disclose? You should disclose the impact and the adjustment resulting from such change in the financial statement. If the effect cannot be determined, right, you have to say that the effect cannot be ascertained. You should state that fact. If a change in accounting policy does not have a material effect in the current period, but it is reasonably expected that it will have material effect in future periods, then that fact should be stated in the current year's financial statement. So by this we are done with accounting standard 5.